Economic bombshells just keep dropping. Yesterday's BLS labor revision just nuked our understanding of the job market, revealing a record overestimation of nearly 911,000 jobs over the past year. Almost a million phantom jobs that never existed, painting a picture of a labor market way weaker than the headline screamed. As if that wasn't enough to rattle Wall Street, today's fresh PPI report is straight up flashing deflation signals, with producer prices unexpectedly plunging 0.1% in August alone. Is this the tipping point for a recession or a golden opportunity for the Fed to slash rates and boost asset prices? So here we're looking at the year over year rate of change for PPI. Before that, we'll go through the monthly data. Yes, it is in deflation. Both producer price index, the headline, and core are showing deflation of 0.1%. However, as I always point out, go back, this chart goes back to 2010. You can see there are numerous examples of a monthly print indicating deflation. However, what matters is the annual averages zooming out. So here we're going to look at headline in white, core PPI in red, PPI commodities in blue, and then core CPI in yellow. I'll point out core CPI is running at 3.1%, 50% above the Fed's long run average of 2%. PPI commodities, this has been a source of disinflation and sometimes even deflation for PPI. As we can see, green represents energy. If you go back to 2023 and parts of 2024, we can see energy was contributing deflation or bringing down that PPI, that producer price index inflation rate, and the vast majority of the PPI inflation is coming from services, as you can see in that salmon colored bar. If you look at goods, it's about 54 basis points out of the total reading. And I had mentioned commodities. So commodities had been providing deflation. This is the annual rate of change for commodities in blue. And we can see that from March of 23 all the way through really November 2024, commodities were growing at, excuse me, the price of all commodities, this is PPI, all commodities, was shrinking. So commodities were providing that deflation. But if you look, this has been kind of starting to reverse when it comes to the rate of change of PPI, all commodities. Now, the expectation for the monthly print, we did come in much lower than expected on both core and headline. The expectation was 0.3% monthly increase on both of those metrics. We came in, again, negative 0.1, showing slight deflation. And then for the headline and the year over year headline, the expectation was 3.3%. We came in well below that at 2.6%. And if we look at core, the expectation was 3.5. Again, we came in way below that at 2.8. Now, again, I will point out that core PCE is running at 2.9%. Core CPI is running at 3.1%. Equities are at all-time highs. Gold is at all-time highs. Home prices on an average national basis are at all-time highs. And we're talking about a 25 or 50 basis point cut. I did want to very, very quickly update the overnight dollar markets, the funding markets, the repo markets. Here's SOFR relative to Fed funds. We've pointed out the spread yesterday, well, many times, but focusing yesterday, it is still elevated at 7 basis points. This is day number 6 or 7 of an elevated SOFR Fed funds spread, indicating that dollar liquidity on an overnight basis is starting to dry up. So I think that a 50 basis point cut is much more likely if that does not start to improve. So PPI, all commodities, we were showing this was contracting, right? Prices of all commodities were growing at a negative rate on a year over year basis. Well, that has started to reverse. If you really go back kind of to September, October of 2024, commodities, the annual rate of change has been picking up, now running at 2.7%. What is driving that? Well, here's oil. And then we're going to show the commodity index. So here's the commodity index. You can see that commodities have been basing, and a large degree of that is oil as well, have been basing going all the way back to January of 2023. If you get a weaker dollar environment, you could see a reacceleration in global growth. A weaker dollar is generally disproportionately benefiting to emerging markets and to some degree, even the developed markets like Canada, UK, France. So weaker dollar policy, global reacceleration and growth. I would expect to see commodities, again, which have been providing deflation for PPI. I would expect commodities to pick up there. People have been calling for a commodity super cycle for 6 months now. If you get fiscal dominance, outright fiscal dominance, I think if I had to guess, oil and commodities would probably do quite well. So, of course, BLS revisions. We have to address BLS revisions. This was the major news yesterday. The benchmark revision, the annual benchmark revision from March of 24 through March of 25 was the largest on record. The source for this chart is Zero Hedge. And we can see that this is the largest negative revision in history. By the way, 2009 had very, very large negative revisions last year under the last administration. So March of 23 through March of 24, we almost tied for the record of negative revisions. I was about 810,000. And as we can see, that was tied with 2009. So these large negative revisions have been occurring. Again, this is not a new phenomenon. And again, it applies from March of 24 through March of 25. So I would hesitate when people are trying to make this a political thing. I don't think that it should be viewed that way. You can also see 2023 had large negative revisions as well of about 250,000 jobs. Now, I want to point out something with the yield curve. We are getting a bull flattening of the yield curve. What this means, the difference between long end rates and short end rates is growing smaller. So the gap is coming in. The jaws are closing, right? The difference, the delta, the gap between the 30-year yield and the 2-year yield is closing, and it's closing in a bull flattener because remember, the value of the bond is inverse to the yield. I will take the spread off. You can see the 10 years gotten bid, the 30 years gotten bid, and the short and belly are getting bid on, of course, rate cut expectations and kind of slowing growth in the estimation of the bond market. Again, I will point out, since the Fed started to cut rates in September 2024, the 30-year Treasury yield is up by 80 basis points. Now, the 10-year, when the Fed started to cut, was trading at 365 and is basically at 4%, 4.00 right now. So, that is a 35 basis point increase in the 10-year. Remember, nominal growth right now is running about 6%. If you look at GDP now by the Atlanta Fed, that's running at 3%. We just had real GDP come in at 3.3% a couple weeks ago for Q2. So again, you have nominal growth at about 6%. Is a 10-year at 4%? Is that really fairly priced? We shall see. Only time will tell. But the weakness in the labor market, partly due to the NFP revisions, which were largely priced in, I think, as it appears, were largely priced in. You didn't see a massive move yesterday when those payroll revisions were released. There's definitely softness being indicated by both the NFP. I will also point out, however, the break-even rate for monthly job creation is not 150,000 anymore. It is closer to 30 or 40,000 as estimated by firms like Goldman Sachs, as well as the Fed themselves. So we got used to very, very large NFP prints of 180,000 and at some points even 200,000 jobs created. But as you see net migration go negative, as it has over the past couple months with the immigration policy that this administration is enacting, you have to remember that the break-even rate for jobs, payrolls being created is going to be much lower than what it was, say, in 23 or 24, when there was a large, dramatic increase in the labor supply. So record revision, almost 1 million jobs. Here we can see the sectors or the industries that are going to be likely most hard hit by compared to the currently stated monthly payroll growth. This is from April of 24 through March of 25, the average. What we can see, manufacturing has been in contraction. ISM PMI employment has been very, very weak for about a year. You can see professional and business services is likely to see a large impact from that is implied by this preliminary benchmark revision. We can see that, for example, government and private education and health, these two sectors are not going to be largely hit. This has been one of those things that you kind of pick up on following the labor market. These have been relatively accurate when it comes to those readings with any given monthly NFP print. when it comes to private education and health and government, those are relatively accurate. If you look at leisure and hospitality, that's quite a significant delta. It's running an average of about 20,000 per month. Well, implied by this benchmark revision, that is going to be closer to just 5,000. Now, this would be hard hit, of course, by the immigration policy and the tightening of particular parts of the labor market that we just were talking about. Retail trade, again, this keeps coming up. Retail trade has been getting hard hit going back months. Every employment report that we look at, retail trade is always soft. And what the benchmark revision is indicating is it's even softer. It's negative by probably about 10,000 jobs, aka 10,000 retail jobs are going away. Retail trade jobs are going away each month. So again, the labor market is certainly softening, and kind of aggregate growth is certainly softening. Is it softening as much as the bond market is indicating? Are we going into an imminent recession? I will point out that in a recession, on average, the deficit as a share of GDP increases by about 800, 900 basis points. So, okay, you're talking about we have a pro-cyclical deficit, 7% of GDP. If we go into a recession, the deficit would go to about 15% of GDP. AKA, put another way, we would be the net new debt issuance would be 15% of GDP. So for the people that are calling for a recession, this is what my question would be. How do you see the bond market and the Fed and the Treasury responding to a 15% of GDP fiscal deficit? I think that is the critical question. If we are indeed going into a recession, like many people are starting to claim, that would be my question. Now, here is the actual report for the revisions. I will link to this in the description of this video. What I want to point out is that, yes, 911,000, the absolute number of the revisions, is quite large. But what really matters, I think, is this. This represents a 0.6% a change or revision. So the long run average, the last 10 years, had an absolute average of 0.2% of total NFP. So this is 3 times the average revision that we have seen over the past 10 years. I think that is really much more important than the absolute number. It definitely gets the headlines: a million jobs, 911,000, and certainly a lot. But once you look at it as a percentage, I think that's probably a more accurate or useful way to look at these things, representing a 3x over the 10-year average when it comes to employment. So I think that's really where the issue should be focused. So here we're going to look at the revisions. This is from the report. I will also link to this in the description as well. Here we're going to look at revisions by sector. And if we look, total non-farm, negative 911. But again, look at the percent that it represents of the revision. If we look at wholesale trade and retail trade, again, very, very hard hit. Wholesale hit almost negative 2% on a percentage basis. Retail trade, which is larger, it was only hit 0.8%, but this is still a significant decline. 126,000 overstated jobs within retail trade. Look at professional and business services, AI, white collar jobs, like being affected by AI. You could look to this: 158,000 overstated, and that represents 0.7%. Professional and business services is likely to be hardest hit by AI. If you look at information as well, this represented the largest percentage revision on a percentage basis. Information, so this is tech, and it only represented 67,000. So again, this is why it's important to look at the percent. It only was 67,000 on an absolute basis, but if you look on a percentage basis, it was negative 2.3%. I will also point out leisure and hospitality, huge revision, 176,000 on an absolute basis. And when you look on a percentage basis, negative 1.1%. So wholesale trade was information was the largest at 2.3% downward revision, then wholesale trade at 1.8, and then leisure and hospitality. Again, this goes into the tightening of the labor market. And again, I will just point out the break-even rate for non-farm payrolls creation on a monthly basis is not 180,000 or 150,000 like it was when we were dramatically increasing the labor supply. Now it is much lower. The Fed themselves say it's about 30 to 60,000. If you listen to some of the economic head of economics at some of the large firms, they will say as well, kind of between 30 and 50, maybe 60,000 is the break even rate, the new break even rate, given the policies when it comes to immigration with this current administration. So again, inflation is running much higher than 2%, is running at about 3%, as we can see. Commodities, which have been giving deflation, helping the disinflationary trend, commodities appear to be starting to pick up. And we were looking here at WTI, and we were also looking at the Goldman Sachs Commodity Index, which is heavily weighted to WTI. It does look like this is probably going to break out, especially if you get a weaker dollar environment with fiscal dominance, negative real rates. Well, if you do, then that component that was bringing down your inflation, providing deflation, as we can see in green down here, energy, mainly oil, providing deflation. Well, if that goes away, you could see inflation start to accelerate due to the breakout in commodities and possibly oil. This looks like it's just on a technical, traders basis. This looks like it's basing and just ready to break out. And again, you would expect that in a weaker dollar environment with fiscal dominance, negative real rates, right? Trump wants to cut the federal funds rate by 300 basis points with core CPI at 3.1. Unemployment, by the way, at 4.3, very, very low on a headline basis, going back all the way to the 60s. And you have assets at all-time highs, home prices, equities, gold. I think the real story is the 30-year yield, which we keep looking at. I keep pointing out it is up 80 basis points since the Fed started to cut. And I think that gold, I think the 30-year, not just for the US, but all around the world, the 30-year is where to watch, as well as gold. Now, remember with gold, you can look at it as gold denominated in dollars. You can also look at it the inverse, dollars denominated in gold. And it's a much different picture when you look at it that way. So, anyways, hopefully this was helpful. Yes, very large revisions. Some sectors more hurt than others, and record large revisions, 3 times the long run average over the past decade, 3 times larger in terms of negative revisions. We got to fix this data. What good is the data when it's this inaccurate all the time? I am in favor of modernizing, trying to address the low response rate, some of the flaws with the methodology. We got to get better data. What's the point of having a monthly NFP if it is so inaccurate? I mean, we're talking 75,000 jobs for the past 12 months from March of 24 through March of 25. Take any of those non-farm payrolls prints down by 75,000 and the picture is a lot different. So we got to get better data, more useful, more accurate data, higher response rates, maybe more modernized. That would be my hope. So anyways, hopefully that was helpful and I will catch you on the next one.